Well, good afternoon, everyone. It's Friday, February 24th. I'm Dave Weisberger, the CEO of CoinRoutes, and it is time for our weekly recap. Actually, it's a 2-week recap because I actually took a week off last week. So let's get right to it. The market, Bitcoin this week, is down somewhere around 7%. Kind of floating downward with the stock market, maybe a little bit more. But the week before, when I was on vacation, it was up over 10% to hammer right up to the 200-week moving average that we keep keying in on. I won't call this particular test of that resistance a failure, but one could argue that we are basically in this trading range. Watching today's trading, where 23,000 seems to be finding some support, even though there's no technical support at that level, makes me wonder. As I've said multiple times in the past, I believe the most bullish scenario for crypto is Bitcoin to continue to flirt with this level off and on, and it's relatively tight, maybe $2,000 range, maybe for another month or so, in order to continue to build the system. Because what you're actually seeing is fairly consistently, again, the perpetuals and other speculative products be a little bit heavier than the spot. And that's kind of indicating that there's still more natural buyers versus speculative sellers. And I expect to see that for a while until there's a catalyst again, maybe in the springtime. But we shall see. In any event, over the same period of time, like today, the NASDAQ sold off heavily, which is one of the reasons that a lot of risk assets did. And so we're kind of seeing this kind of choppy action. Not surprising. As I said, it's higher than it was the last time we talked 2 weeks ago. Really not a whole lot of information. But there's been a lot of news in the last couple of weeks, and I'm going to focus most specifically on two that are kind of diametrically opposed. Now, if you remember last time, I talked about people worrying that the banking regulators were going after crypto and something that they were calling a new operation choke point. And maybe there's some truth to that in the bowels of Washington. But yesterday afternoon, we saw a really interesting press release by the joint banking regulators, the FDIC, OCC, and the Federal Reserve. And what they said made enormous amounts of sense. So listen to this. They clarified all the previous falderall about the banking industry not wanting to touch crypto by making 2 points, both of which I agree with. And I want this to be clear because they're both very logical. Point number one, if you're talking about exchanges that are holding client assets, they made the point that those assets, from the point of view of a bank, are more volatile. Not for any bad or nefarious reason, but for very simple reasons. Because if you deposit money on a crypto exchange, the net assets of the crypto exchange don't go up and down that much. I mean, obviously they go up and down with the price of the assets, but the dollars are there and the crypto is someplace else. So if there is an event, say a big bull run in Bitcoin, where people are FOMOing to buy, the cash is going to go down very fast as people buy into crypto. And if that happens from the point of view of the bank, they can see their cash reserves drop precipitously. Now, why does this matter? You have to remember, people, that banks in the United States, in fact, most of them in the world, with the exception of the proposed Custodia Bank in Wyoming, are fractional reserve institutions. What does that mean? As a matter of practicality, if they have $100 million in assets, they probably only keep 10 million on hand and they loan 90 out. But if, let's say, half of their assets were in from crypto exchanges and a big bull run happened in Bitcoin, they could have a serious liquidity problem. And regulators don't like that. So what the regulators said is you need to risk manage. You need to make sure that you can meet your capital reserves if you have a lot of crypto deposits, and be aware that those deposits are more volatile than like a software company like CoinRoutes. Our cash deposits in the bank don't move that much month over month. Sure, they go down when we pay bills, and sure, they go up when we receive customers paying us, but the overall level doesn't move. Were we a crypto exchange, it will be far more volatile. And that point is true. The second point they made is about stablecoins, and that is also true. A stablecoins, for the most part, whether it's Tether or USDC, are used. Sure, they're used as payment rails, but they're all, which is somewhat stable, but they're also used to be a store or a place where you could use those stablecoins to buy crypto. Same thing. In a bull run, the stablecoins could go down in the terms of reserves and get pushed into something else. Remember, the stable coin is probably more stable than the crypto exchanges, but it's still subject to volatility in terms of whether people want them or not. So that's all they said. But what was particularly important is the last line. And I'm not going to read it to you, but effectively what it said is you cannot, or you should not discriminate against businesses that are legal. You merely should make sure your risk management is right. Now, that is wildly different than what was being reported on as recently as a week ago. And it's fascinating to me that 3 different banking regulators felt the need to tell people to calm the F down, saying, we are not trying to shut you down. We are trying to make sure that banks don't take bad risks. And so they're doing their job. We shouldn't worry about it. Now, that is diametrically opposed to the continued nonsense coming out of the SEC. I hate to beat a dead horse, but it's getting ridiculous. Over the last 2 weeks, everything the SEC has done has been about jurisdiction. Last week when I was on vacation, they did a great indictment against Do Kwon. So they're going to assert in in their particular suit that Luna and UST are securities, knowing full well that Do Kwon's not going to set foot in the US because he get extradited to Korea where he's wanted on criminal charges. Remember, the SEC is only civil charges. Now, it's possible that our law enforcement will find them and maybe he'll be able to defend it, but it's the weakest person they have yet gone after to try to get legal precedent in terms of what is a security. And that is clearly about jurisdiction. It is not about helping investors, but they've done a couple of other things. The next thing they did was and we talked about suing Gemini, but the next thing they just recently did was they sued to block Binance buying Voyager's assets. So that something that would have undeniably helped Voyager investors in the United States, they're suing to block it. And they're doing so for jurisdiction. My friend Scott Melker had one of the all-time great tweets. He basically tweeted that basically what the SEC was doing was they found a dead lion in the jungle. They stabbed it a few times, and then they dragged the lion back to the village to say, hey, we protected you from being eaten. And oh, by the way, you can't eat this lion even if you're starving. Not that a lion would taste all that good, but if you're starving, they probably would want to eat it. I cracked up when I saw that tweet, but it's exactly the truth. What are they trying to do? They're not protecting people. They're trying to assert jurisdiction. So why do I care so much about this? Why do I keep ranting about it? Well, I rant about it for a very simple reason. Hester Peirce makes the point consistently, did so in her dissent on the Kraken, did so in many other places. This form of regulation by enforcement does not provide clarity for new entrants. The only people it provides clarity for are those who come in, pay a fine, have a backroom deal of what they could do, and they move on. This is a way not to build a market. It's a way to discriminate against smaller, innovative firms in favor of larger, more established firms. But the more established firms in crypto don't want to deal with it either. Like Jesse Powell commented, oh, you mean I could have just registered? It was so easy? Well, obviously it isn't. And, we keep talking about it, but it's completely different than the banking regulator approach who's saying, listen, we want to deal with risk. Now, I want to be very clear here. When Gary Gensler talked about these things, in the most recent time he went on one of his videos, about half of what he said I agree with. He is 100% right that we should have better and more accurate risk disclosures. I completely agree with him that issuers should have to disclose tokenomics. I agree that we need regulation in order to understand market manipulation. We should understand what customer assets are protected. Frankly, from CoinRoutes perspective, we care a lot about reg best execution. And I am in the process of writing a comment letter on the recent SEC proposal about that, which in fact mentions crypto securities, even though that's totally undefined in the release. The problem is the fact that you have no rules that anybody could use to run anything close to the existing businesses of exchanges is a problem. They need to be rewritten to understand that it's a 24/7 market, that it natively supports on-demand settlement, that it's natively multi-currency. You could trade against dollars, euros, Bitcoin, or stable coins against the same asset. They're not different assets. They're just pairwise. And none of the SEC rules work for any of that. And there's more. The fact is there is a need to work with the industry, which is exactly as we talked about previously what the UK is doing. But the press coverage over the last 2 weeks has been totally disingenuous. I read an article this morning, and I won't pick on him, but the author effectively, he quotes Hester at the end, but doesn't mention the fact that the rules don't work and that there's no way to jive unless you start with rules and then move to enforcement. Doing enforcement first is completely backwards, and that's something we shouldn't do. I really don't want to rant anymore about this, but I suspect that every week we're going to keep hearing about it because they keep doing more and more stuff. But for now, let's take the win that the banking regulators understand that you shouldn't automatically chill everything involved in crypto. And when they make reasonable demands about how we should take into account risk, they should be listened to. The only point I will make in closing is that when the Federal Reserve turned down Custodia Bank, which had none of those issues, I think that needs to be rethought. And I wish Caitlin Long and her colleagues all the luck in the world. So for now, stay safe out there. Have a great weekend. See you next week.